How we protect against market loss, because we've talked a little bit about that, and like I said, you don't want to put all your eggs in one basket, but let's get more into it. Now, we look at two major types of market risk, because there are two major types of risk in the market. We look at unsystematic risk and systematic risk. Unsystematic risk would involve things like investing all of your funds in one company and I don't say hoping for the best, but watching what happens. Let's call it that. So let's say you invest all your money into Apple, which, in 1992 would have been a great idea in 2025, even though Steve Jobs died. And usually when the CEO or the mastermind of the company dies with it. So that's what we're talking about when we talk about unsystematic risk. Fortunately, that didn't happen for Apple. But I don't think it would be worth testing out again with another company. Let's say it that way. Now, let's look at Citigroup. In 2007, if you had all of your money invested in Citigroup, within about a year, I think they lost, I want to say 96, 97% of their value. So if you had $1 million in there, well, you can see the chart. So how do we get around this? Maybe let's just skip to that, because that would really be helpful, right? So diversification would be the way that we would get around that. Don't put all your eggs in one basket. Now, investing into a broad range of different types of companies, different types of sectors. Different people that you listen to will have varying ideas on how much. Like Kevin O'Leary, Mr. Wonderful. He speaks about how his mother did investing, and it's pretty smart. No more than 5% in one stock, no more than 20% in one sector, and that's just how she did it, and that's how he does it. Do we follow just what Kevin O'Leary says? No, but look at the guy. I mean, he's done okay. So he has words of wisdom, so we pass those on and share them. So, but there is some serious value in spreading the risk out over different sectors. Now, does that mean that we should just spread it around different assets within the same market? Not necessarily. We'll get into that too. Now, if you had put that $1 million into a portfolio that looks more like this and had 17% or so of Citigroup, then you would have been down about $160,000, unless the rest of these go down too. So the idea is that these others make up for that potential downturn, unless you end up with systematic risk, right? Now, systematic risk would look something like if you had that $1 million stretched across the broader market in different sectors in the stock market, for example. You got the whole $1 million in the stock market, but it's in different sectors and in different stocks, different companies, right? That would be okay, but it also wouldn't be enough to alleviate the systematic risk. Now, what are we talking about? For example, 9/11, there are wars, there was the banking debacle, we'll call it that, in 2007, 2008, right? What does that cause? Well, let's take a look. And in fact, we're going to look at 2008 specifically for a reason, and I'll get to that in a minute. Now, if you take that $1 million and you invest it 25% in each of these different indexes or indices, depending on how you want to say it, then you end up with $1 million stretched across all these indexes, right? Now, that's great as long as things are good. Now, watch what happens to all four of these indexes as we move through 2009. And we'll put the whole portfolio up there and see what happens. Wow, look at that. So if you have your $1 million over here, it's growing, 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 and then it drops 30. And and then it drops 30, it was about 38% or so average, I think, in the space of about 15 months, if I recall correctly. So were you protected? No, not exactly. So if you had your whole $1 million and that was all of your life savings in that account or those accounts, sure, you would have gained, but then the whole thing would have dropped. Now, there are a lot of people, it took about 6.5 years or so to recover back to break even after that. And so remember we spoke about opportunity cost? What could have happened? What could their money have done for those 6.5 years while it was getting back to where it was before? I mean, if you're old enough, you know, then you'd probably be really happy that it got back to where it was before because you're made whole again. But what could your money have done in those 6.5 or however many years it took? That's the question. And how do we get around that, prevent that to the extent that we can, and keep things balanced and growing? You know, and for some people, we throw some guaranteed income in there too. You know, then life is even better, and they don't have to worry about this kind of thing. So how do we do that? Now, let's take a look. So this is a chart of the market. It's a monthly chart of the market, S&P 500 specifically. It starts in 1980. Wow, 1984 is right here. And this is the dot-com bubble. Some of you recall that. And this is the banking mess in 2007, 2008. This is about a 38% drop. And if you look, you can see where those years that it took to recover came from. So here's a question for you to ponder, write it down. If you have $100,000 and the account value drops 50%, does it have to come back up 50% to get back up to 100,000? Ponder that. Okay, now the market takes off in 2008, and we have a flash crash here, and then a pullback here, and another pullback here. This was that day in April, what do they call it? Oh, Liberation Day is what they call it, right? Down goes the market. And then from there, we've gone up. And we've hit a little bit of volatility here. I don't know if some of you are watching the market or not, but last Friday, I think the S&P 500 was down 217 points when it closed. But then it was back up again. So volatility doesn't necessarily mean the market's going down. It just means it's going up and down and chopping a lot more than it is going up in more of a steady line, right? Now, we are big proponents of having some money in the markets for sure, especially now, because to be honest with you, we think that the stock market is about to take off like a rocket ship. Does that mean that it's going to do it today, or that it's not going to pull back 38% before it does that? No, absolutely not. However, with the way things are going with data centers, AI, the need for power, the need for materials, the need for rare earth minerals that go into making reactor plants, reactor technology, and some of you may be aware of this and some of you may not. They're building a fusion reactor plant in Malaga, Washington, which is right next to Wenatchee, Washington, central Washington. So the first fusion reactor plant is set to be built and online providing power for Microsoft's data centers. I believe it's in 2028. But and I don't know how you guys feel about that, but that's history making, because to my knowledge there aren't any fusion reactors in the world yet. And the best part of this is that the reactants that go into making this reaction happen to make the power, a lot of them are recyclable. So they send them off over here, they decay for a while, they put them back into the reaction, they use them again. So the cycle it's brilliant. Anyway, we can talk more about that too. I could talk about it all day, but we can talk more about that if you want to. Now, why do I put this chart up? Well, and why do we look at 2008? Well, because this drop here was about 38% or so. If you take 38% and take it off of where we are now, that brings you down to about here, where there's actually really good support for all of you chart nerds out there. I'm actually working on becoming a chartered technical analyst myself. I'm in the process of doing that. So if you want to consult on that, I'd be happy to as well. Now, you bring the S&P 500 down here, and you're 70, and all of your eggs are in this basket. One, we need to talk right now. And two, your recovery time is going to be awful, because and when you retire and when you start drawing in your funds is just as important as how much you have in all of those accounts and what types of accounts. Because if you just retired and or you're 70 years old and that happens over, say, the next couple of months, then you're going to take a hit that you may not recover from, and it may actually add stress to your life and lead you to be unhealthy faster. And that's all I'm going to say about that. But that's avoidable. How is it avoidable? Well, I'm glad you asked, because I have answers. So asset allocation was alone is not, and diversification, they're not alone. They're not enough alone to mitigate the potential losses and or downturns that the market can hand us any given day, right? So how do we do this? We put some money in what we call a principal protection program. In other words, those protected accounts, fixed index annuities, cash value life insurance, if it's suitable and you're eligible. What does that do? It basically just gives you airbags. So we look at it like like a game of tetherball. I don't know how many of you remember that game, but there's a pole in the ground, and there's a chain or a rope, and there's a ball, and you hit the ball around, and you hit the ball around. So the way we look at it is these protected accounts are your pole in the ground. They're solid. They're not going to go down. They're going to go up most of the time, but they're not going to go down. And a lot of them provide lifetime income for you as soon as you want to start it, right? That's a whole other subject that we can get into later. And actually, this is pretty exciting, so I'm going to throw it in there. Now, we only work with A-rated annuities, the best ones out there. A lot of them, the ones that we work with, have 20+% bonuses for whatever you put in. Now, consider this example. We talked about doing Roth conversions, and you can Roth convert any amount in any given year that you want to. You just have to pay taxes in that given year. Let's say, you want you put $100,000 into an annuity, you get a 20% bonus. You're in that 22% tax bracket, and you want to Roth convert all this over a certain number of years. Well, if you have $120,000 to start, and you only had $100,000 that you put in, and you're going to be taxed $22,000, then essentially the company, the insurance company that sponsors these programs, has paid almost all of your tax bill to do the Roth conversion for that entire account. Now just think about that for a second, like how powerful that is. Because I don't know about you, but if I can get somebody else to pay my tax bill for me, then I will at least have a conversation with them. It's at least worth a conversation, right? Because you wouldn't be opposed to that, would you? I certainly would not. Now, let me talk about this life insurance retirement plan for another minute too, because it's just as important, if not more so. The way these work, when you fund them, the money that you put in there becomes borrowable. Now, there are people that are going to say, oh, why would you ever borrow your own money? That's stupid, and other such things. Now, here's the reason that it's actually not. Because when you put, in our example, Jack and Jill, we have them funding a life insurance retirement plan. We call it a LIRP. We have them funding one at $50,000 a year for the next 12 years. Now, what are they going to get out of that? Well, let me tell you. They just funded year 2, and we did their Roth conversions last year to help them get into tax-free status. They borrowed funds from that account, from that life insurance retirement plan, to pay the tax bill. Now, set that aside for a second, and hang on, because this is where things get trippy. They've put in $100,000 so far into that account. They made gains on that $50,000, the first $50,000 for the first year. They're going to make whatever gains they make on that $50,000 for this year. even though they borrowed money out, they're going to get paid gains on the whole amount of money they put in there. All of that money that is still in there, they will make gains on. Not just what they put in less what they borrowed. Keep that in mind, because that's powerful. So you say you have $100,000 in an account and you've gotten paid, you gotten paid 10% on 1 year, then you get paid 10% on the next year, and then it compounds. So you're up to what, 115 or so. It depends on the account. Then you borrow, say, $60,000. You're still going to get paid the third year. You're going to get paid interest on the whole lot. So 115 here plus another 50. You're going to get paid interest on 165, not 105, because they took 60 out. Hopefully that makes sense. And if it doesn't, you should definitely call us. And you should just definitely call us anyway, just to see if you're eligible to do this, because this is super powerful. Now, we work with another couple who will be Roth converting about $1 million that they had in their 401ks over the next 5-6 years. They're also funding a life insurance retirement plan similar to the other couple we talked about. All of the money that they pull out, all of the money that they have to pay the IRS for all of their Roth conversions for that whole $1 million is going to come as loans from their life insurance retirement plan. So basically, the insurance company is going to pay their tax bill to Roth convert all their funds so that they can be even closer to a 0% tax bracket. Now, I don't know about you, but that excites me. And the reason you can do that is because it's a loan. And loans don't produce a 1099. They're not counted as income. And even if you decide you want to get a lifetime income stream from either these annuities or the life insurance programs, they're written as loans and not income. So they don't generate a 1099 and they don't count as income per se. Now, I don't know about you, but that excites me. Not only does it excite me, but would you be opposed to at least having a conversation that leads to you not paying your own tax bill if you could do it and it was legal and all the other things? Would you be opposed to that? I know I wouldn't. Let's talk.